In the last few days, something interesting and strange is happening in the market. Gold prices are rising and the Indian stock market is falling down continuously. But what's strange in that? Isn't that just normal market movement? Well, no, because behind the scenes things are not so great and the market is whispering us signals of something bad coming soon. And in today's video, I'll tell you what those signals are and why you should not ignore them. First, let's talk about the Indian stock market for a second. Since the last few days, we've been getting a whole host of good news like tax cuts in budget which will increase the consumption power of the general public, RBI's first ever rate cut in the last 5 years which will decrease the cost of borrowing, thereby increasing consumption slightly, and BJP winning in Delhi which will increase the political stability throughout the country. But the market is still going down. Somehow these news pieces have failed to affect the market in any positive way. So aren't they good for the market? Well, the general public thinks so, but the big players think otherwise. You see, inflows in equity mutual funds has stayed near the all-time high of 40,000 crores since the last 2 months. This means that the retailers are buying at any level continuously and FIIs are selling at any level continuously. In fact, in January itself, FIIs have sold stocks worth 87,000 crores. Surely FIIs are not that dumb to sell without any reason. So are the retailers becoming the bag holders for the FII by believing in the facade that has been put up by the perma-bull news anchors and social media influencers of today's time that everything is alright? Now here's the con of being a common man or a retailer in the market. You don't have a lot of insider information and most of the times you only know the reason for why things happened after they have happened. But an ant's presence is unnoticeable and an elephant's presence is impossible to not notice. And in the market, the ant is the retailer and the elephant is the big institution with thousands of crores. So when the elephant runs, you'll surely get to hear his footsteps. And here's where the whole horde of elephants is all together running towards gold. There is so much happening in gold since the start of this year, but surprisingly, no one is really talking about it seriously. You see, gold is a de-risking asset, that is, people move their money into gold when they want to decrease the risk of their portfolio or when they want to move towards safety in times of uncertainty. And since the start of this year, gold prices have already appreciated by more than 10%. So who the hell is buying so much gold and why? It looks like someone is buying gold in a hurry so that they can quickly run towards safety. But this rally in gold is doing something else too, and that is making the Bank of England go broke. But how? You see, when a financial institution buys gold in the overseas market, the London bullion market being one of the biggest, it can often be difficult and costly to bring the gold back to its own country. And here's where the Bank of England comes in. They can store your gold for you in its vaults in London itself. Here's where things start to take an interesting turn. Now Bank of England may decide to lend this gold that is stored with it to someone else to earn a little bit of extra interest on it. Now this is fine until it is not done on a very large scale and the borrower of the gold returns the gold back that it has borrowed. But things take a turn for the worse when the borrower defaults on his payment. You see, when the borrower borrows gold from the Bank of England, it gives an equivalent amount of cash to the Bank of England as a security. And so if going forward the borrower defaults on his payment of gold back to the Bank of England, the Bank of England gets to keep the cash but doesn't recover the gold. But the Bank of England needs to hold gold because it's not their property and they'll need to keep it the same. So what does it do? It goes out and buys gold from someone else. And what's the problem in that? The problem is in the price of lending the gold. Most of the lending that the Bank of England has done is not from the recent times, which means they've lent the gold out at a much lower price and not at the current record high prices. So let's say the Bank of England decided to lend 1 million ounces of gold at $2,000 per ounce to someone back in 2024 and collected $2 billion of cash for it. Now let's say that borrower defaults on his payment of gold and the Bank of England is left with $2 billion in cash. But the Bank of England needs to have the gold with itself, not the cash. So what does it do? It goes out and buys the gold from the open market. But in the open market, the price of gold is currently at $2,900 per ounce. This means that the Bank of England has $2,000 for every ounce of gold that it wants to buy, but it will need to pay $2,900 for every ounce of gold. And this difference of $900 is something that the Bank of England will need to pay from its own pockets. And then you can imagine how this gets out of hand when we are talking about hundreds of tons of gold. But that's not all. Now, if you are a financial institution which has kept gold with the Bank of England and you hear what I just said, what would you do? It's not hard to guess that you would probably get your gold out of the Bank of England's vaults and get it delivered to you, right? And that is what everyone has started to do. Since December, 400 tons of gold has already been moved out of Bank of England's coffers because of the fear that the Bank of England may not have enough gold to deliver it to everyone who owns it. And this is almost at the level of delivery that happened at the time of the COVID crash. And this is where the Bank of England faces another problem. You see, Bank of England cannot just go out and take back the gold that it has lent out to its borrowers at any time. And so if the amount of gold that needs to be delivered to the owners of the gold exceeds the amount of gold that is currently present in the vaults of Bank of England, then the Bank of England will need to go in the open market and buy the gold, effectively pushing the prices of gold higher and facing even more loss. Now, the only way Bank of England will be able to handle this situation is by printing more of their currency, the pound, and using it to buy gold. But if they do so, they will be injecting enormous supply of pound in the market, effectively devaluing it a lot and breaking things in the process. And the ripples of these breaks will be felt throughout the global financial system. And the final nail in coffin which is of concern is Japan. So why is Japan a cause of concern? And the simple answer is the Japanese yen carry trade. First, let's understand in short what a carry trade is. A carry trade is where you borrow money at a lower cost and then invest it in assets which give you a higher yield and pocket in the difference. For example, I borrow money from my friend at 5% per annum and invest it in an asset which is giving me 15% per annum, and then I pocket the difference of 10% as my profit. This is what a carry trade is in its most basic form. Now let's look at it in the context of Japan. Currently, the Bank of Japan lends money at an interest rate of 0.5%, which is very low. Now, someone can borrow this money from Bank of Japan at 0.5% interest and invest it in much higher yielding assets like the US government bond, which gives 4.5% currently, and pocket in the 4% difference. But there are multiple ways in which things can go south. One of them being the Bank of Japan raising interest rates, which will make the cost of borrowing higher, thus making the carry trade less lucrative. Additionally, if the Bank of Japan does raise the interest rates, the Japanese yen will also appreciate, making the repayment of your borrowings more costly. Now, I cannot explain to you how this happens in detail in this video because then the video will become too long and everybody will just sleep while watching this video. But I've written an article where I've explained how a carry trade works exactly in a lot of detail. The link will be in the description. But raising rates is bad for carry trades like this, and this can lead to what is known as carry trade unwinding, where the person who has entered into the carry trade sells his high yielding assets and repays the borrowed money. These high yielding assets very often include stocks, and when we are talking about hundreds of billions of dollars being invested in stocks through carry trades, the results won't really be very pretty when the carry trade unwinding starts and people try to sell these assets. And how do I know that the Bank of Japan is going to continue to raise rates in the future? Simple, the Japanese 2-year government bond yield. Most of the time, the 2-year government bond yield acts as an excellent predictor of where the interest rates are heading in the near future. And here's the chart of the Japanese 2-year government bond yield. If you see, the government bond yield is just rising through the roof and is going up in a parabolic fashion, which is indicating that the Bank of Japan will continue to raise interest rates in the near future, which will cause carry trade unwinding and a simultaneous fall in risky assets. But the market is a forward-looking entity, which means it might not even wait for an official interest rate increase to start carry trade unwinding. It might even start carry trade unwinding right now itself as it looks at these skyrocketing yields. All in all, the market is giving us a lot of signs that an impending crash-like scenario could soon hit the markets. And I know that I might sound like I'm trying to spread only fear on the internet just to get attention, but what I'm trying to do can be explained by this very short clip from my all-time favorite movie, The Big Short.
These outsiders saw the giant lie at the heart of the economy, and they saw it by doing something the rest of the suckers never thought to do. They looked.
With this, I would like to end this video by saying a quote that I've written. Money is not made by listening to the shouts of the crowds, but it is made by listening to the whispers of the giants. And I hope you too are listening to those whispers. See ya.